There's a much anticipated budget coming up, and today I just wanted to talk you through a few of the potential tax changes they're discussing and what impact that could have on the market. The first one is the stamp duty changes. So how stamp duty works today is when you go to purchase a property, whether it's to rent it out or it is to live in it yourself, you'll pay a percentage of the purchase price in stamp duty tax. Now, this is tiered system as well, so the higher the property value that you purchase, the higher the percentage of tax you pay on that property to purchase it. Now, what they're doing is they're talking about moving the liability of stamp duty from the buyer to the seller. And what that basically will mean is that right now buyers have to save up for a deposit, but they also have to save up for the stamp duty tax when they purchase the property. And this is really hindering the market, especially in the higher price bracket, over 500 and over £1 million purchase price, because the percentage of stamp duty is quite high at those levels, and therefore it's making the market difficult for buyers, right? When they do move that over to the seller's liability, then there's many ways they're talking about how they could implement that. One that I saw was that they're talking about doing an annual tax, but when they say annual, they're not actually talking about charging the sellers annually. Instead, they're thinking of charging the sellers at the point they sell, given the number of years, maybe between when they live there or from the date this is implemented. They'll pay an annual fee, and that tax liability will not become due up until they sell. So at the point of sale, they will pay the liability of stamp duty based on the number of years they've lived there or from when this bill comes in. So it won't be an annual cost to those sellers. Now, this will have a huge impact on the market, right? So because buyers won't need to save as much cash to purchase a property, they will be more liquid and be able to bid higher on properties, and it will drive up demand, so driving up property prices. Also, at the same time, sellers will be less incentivized to sell because they'll have a tax liability on the sale of the property. So what you're probably going to see is an increased demand and a decrease of supply in the property market, which will lead to overall higher house prices. Now, from the government's point of view, this is great because typically an indication of an economy doing well is the property prices increasing. However, for buyers and sellers, it will probably have an overall negative impact because sellers won't be able to liquidate their assets as easily without incurring a tax bill, and buyers will have to pay higher prices for those properties as well in the market. Inheritance tax. So currently, in a state, when you pass away, anything over 325,000, you're paying inheritance tax on. Now, they're discussing two potential changes here: either reducing that threshold, so you're paying tax at a lower threshold, so meaning more people will pay that tax, or increasing the rate of the tax. So they are discussing those two. I think the overall impact of those will be as large as some of the other taxes they're discussing. I think it is something they will really consider doing because minimal political backlash as well. Another tax that might be impacted in this budget is income tax. Now, Labour has pledged not to increase income taxes. However, given the financial situation they find themselves in and the fact that they want to keep spending, increasing public spending, might have to look at this, right? Also the biggest lever they can use, because more increase in percentage, because it affects so many people that are currently paying income tax, will raise the most amount of money in the quickest manner. They're talking about increasing potentially by 1% on either basic, additional or higher rate taxes. Put into perspective, a 1% increase to the 20% tax bracket would raise $8 billion a year for them. A 1% increase on the 40% tax bracket would raise roughly $2 billion a year for them, and a 1% increase on the 45% tax bracket would raise $230 million a year. So as you can see, the 20% tax bracket is obviously where, if they increase the tax rate, where they'll earn the most from. What's the overall impact of this? I think right now Labour is very much, as Keir Starmer says, wants to aim at taxing the wealthiest in society. Those with the broadest shoulders should bear the burden. So I think they will look at increasing additional rate tax in particular. However, as you can see, as a percentage, increasing those won't raise a significant amount of tax revenue. I think they will have to start looking at the basic and additional rate tax, and I do think that's also the right thing to do. But in terms of what this will impact on the market, I think if they start going really heavily increasing the higher rate of taxes, income tax bands, I think that will lead to people in those jobs and roles moving abroad, because they will disincentivize from working in the UK, and they will typically have an easier time finding jobs elsewhere paying similar but in lower tax zones. Basic rate of tax, increasing those, I think they obviously impact people, and it will hit people's budgets who are on maybe slightly tighter budgets. So you will see that hitting the ordinary worker, but I think in the long term that's probably the best lever they have. Another tax that they are looking at potentially changing is adding or increasing the scope of national insurance to include rental income from landlords who own properties in their personal names. So what this will mean is that as a landlord, if you own properties in your personal name, and for example your total rental income, to keep the numbers simple, is £50,000, you'll pay a percentage of that in national insurance tax every year. So you'll be charged national insurance tax on that to about 8%. So then that will obviously impact your returns on your properties, and it will also mean that realistically what the impact of this will be is that landlords will probably either look to exit the market because their returns are being hit and reduced, or they'll look at increasing the rents. So I think the impact of introducing a national insurance expansion to include landlords' rental properties in their personal names will lead to higher rent, lower supply of rental properties, and that will also push up higher rents as well. Another tax they're talking about changing or reducing the limit on is capital gains tax. So currently everyone has a limit of roughly £12,000 per year in capital gains that they can write off and pay no tax on. Anything above that is taxed at 18% basic rate taxpayers and 24% for higher and additional rate taxpayers. Now, what they're talking about is changing the 12,000 threshold down to 3,000. So what that means is that any capital gains you make that year, you'll only get a £3,000 limit where you pay no tax, and then above that you'll pay the 18 or 24% tax based on the tax bracket that you're on. The overall impact of this will be that as it's becoming more expensive to sell assets, less people will look at selling, will keep hold of assets, which will increase assets value over time. So it will lead to stuff like property prices and stocks and shares increasing in value because people will be less inclined to sell them because of the tax liability on the sale of those. Next, VAT. There has been some discussions of increasing VAT. Currently, VAT is paid as a value-added tax on goods and services you purchase in the UK, and it's currently 20%. They are talking about increasing it now. If they increased from 20 to 21%, they'd raise roughly £9 billion a year in tax receipts. So you can see it's a massive impact to their budget and increased spending that they plan to do. So I think that would be one of the routes they are going to seriously consider, even though they have pledged not to do that, but it is a big leap. What impact that would have? I think naturally spending on goods and services that require the consumer to pay VAT will be hit, because that'll mean an increase in the cost of the goods and services. However, a small 1% change may not have as major impact as some of the other taxes that they are discussing. So the final one I wanted to discuss was ISA thresholds. So currently in the UK, you can invest up to £20,000 per year per person into stocks and shares, ISAs, and any of the gain that is made in those ISA accounts is tax exempt. So if you invest £20,000 and just keep numbers simple, increased by 10% over the years, it's now worth £22,000. That £2,000 is not taxable. Now, what they're talking about is reducing that threshold from 20,000 to 10,000. So reducing the amount people can invest into their ISAs every year. Now, I think the overall impact of this is very negative, and less so from a financial point of view, but just from a point of view of what the government is encouraging people to do. So ISAs obviously encourage the day-to-day person to invest in stocks and shares, invest in assets, and save money. They're reducing these thresholds and these benefits for day-to-day people. It will disincentivize people from investing in assets and therefore building long-term wealth, and then long-term making them more reliant on the government in the long term. That's it for this video. We've talked through a number of the potential changes that they're looking at making in this budget. If there's anything else you've heard of or you want to discuss, let me know. Hope you guys found it useful. Thanks.